Okay, hello everyone. This is basically chapter 15, the continuation of chapter 15. We started talking about the first part of it, which basically we covered the section 1, which is describe the core performer stock. We also talked a little bit about what would happen is when we reacquire it. And we use the analogy of the proportional shares, and we also use the analogy in an illustration of the incremental method as well. So we talked about that last week. So now we're going to go into another part of the section of chapter 15, which is what happens when we sell stock, we buy it back, and we reissue that stock again. So we're going to talk about that, and that's really this section 2 right here of what's going on. So let's talk about that. So corporations purchase their outstanding stock, and it provides tax-efficient distributions of excess cash to stockholders. It also creates a potential of increasing earnings per share and return on equity. And the reason why is because if you have profits and you have less common shares outstanding, therefore the top line stays the same, but the bottom or the denominator is actually becomes smaller. So, for example, if I were to have a, let's just say $1 million in profit divided by 100,000 shares, that's going to give me a figure of 10. But if I have $1 million profit and I only have 10 shares, let me write that in there, then that's going to give me a $100 figure, and really 100K is what it would be a figure. So as a result, the return on equity becomes substantially higher as a result of that. Okay, so we increase our earnings per share. We provide stock for employee stock compensation contracts or to meet the potential merger needs. So if we have to merge with another company and they require a certain amount of shares or outstanding, we have to look at that. The other thing is to thwart takeover attempts or to reduce the number of stockholders. So we might increase shareholder value by doing that, and to make a market in the stock. In other words, we might reduce the shares so it increases the price value of the share price for that company. So there's quite a few benefits that go along the line with that. Okay, so let's look at just some examples. The way that we purchase treasury stock, there's two acceptable methods according to GAAP. One is called the cost method. The second is called the par, stated value method. Cost method is more widely used, and we'll cover a couple of different scenarios with that. Par value is not so much used anymore, but it is an accepted method. Treasury stock reduces stockholders' equity, so that's where the treasury stock would go. When we would buy back shares, we're going to buy it back through what we call our term treasury stock, and therefore it's going to reduce the stockholders' equity as a result of that. Okay, it goes in the equity section of the balance sheet. So here's an example of Kripe Company issued 100,000 shares of $1 par value, common stock at a price of $10 per share. In addition, has retained earnings of $300,000. Okay, so right away we can tell that we issued the shares at 100,000, but we actually have some additional paid-in capital. So what it really did was it sold for $1 million. So if I were to write this, I would have cash received of 1 million. I would have common stock, and that would be of 100K because that's the par, right? And then I also have additional paid in capital, or what we called paid in excess of capital, common stock, and that would be the 900,000. So that's all that they're saying here. As a result of that, it totals $1 million total outstanding that they received in cash as a result. Okay. And there's also $300,000 in retained earnings. Retained earnings is really that bucket. It's accumulated profits over the years, and so therefore they have $300,000 in retained earnings. Okay, so the total stockholders' equity is $1.3 million. Okay, so in this issue on January 20th, Kripe acquires 10,000 shares of its share, 10,000 of his shares at $11 per share. So we're going to record the acquisition as follows, and basically all we do is record this dollar price at what the acquisition price is. So we know we bought it back. 10,000 shares times 11 is going to be $110,000. So that's our cash that we spent, and then we reacquired the treasury stock for the same $110,000. So nothing fancy here, okay? So now the question comes into play. Well, and before we continue on the problem, notice where the cost of treasury stock goes. It goes in the retained earnings section, okay? And it reduces total paid in capital and retained earnings. So remember, it's a contra to equity. So because we're buying something back, so we're reducing the outstanding shares. Okay, so now we have a sale of this treasury stock. So we initially sold a bunch of shares and got money. Now we're buying some of that back for reasons that we demonstrated in that first slide. And if we were to sell this treasury stock again, the same treasury stock we bought back, now we're going to sell it again. If we were to sell it above cost, what would it look like? If we were to sell it below cost, what would it look like? Okay, so in the sale of the treasury stock, it's going to increase the total assets and the stockholders' equity by far. Because remember, when we buy back treasury stock, we buy back shares, we're buying back treasury stock, that reduces equity. Well, now if we resell it again, it's going to increase our equity as a result. Okay, so let's look at that. If we were to sell it above cost, what would that look like? Kripe acquired 10,000 shares at $11 per share, and it now sells for 1,000 shares at $15 per share. Remember, our transaction was originally we bought it back, treasury stock, for $110,000, and then we expended cash for $110,000. Okay, so that was originally when we bought it back. Now we're going to resell it. So what happens when we resell it? Well, if we were to look at the cost value, okay, and we want to record that, then we have a cash asset of $15,000. Then our treasury is a contra. We record that at cost, okay? So we record it at $11,000, and then we have a paid-in capital from treasury stock of equity of $4,000 for the difference, okay? So the key is right here is that we are recording this at what we bought it for, which was, remember, this $110,000, okay? So we bought it for what we were issuing it or reselling it, excuse me, at the same share price as what we bought it back for. Okay? What happens if we sell it below cost? We sell it below cost, now we have an issue. We record the sale, we only got $8,000 in cash, but we have this paid-in capital from treasury stock, this equity, is going to be a debit balance, not a credit balance. And so that pulls us up to $11,000, and then the remaining balance is that we resell treasury stock at $11,000. So we still record this at the cost, okay? The difference, or the plug, is simply this $3,000. But where does it go? Well, in this case, it goes on the debit side. In the other case, it went on the credit side. Okay? Now, what happens if we sell an additional 1,000 shares at $8 per share? Okay? Well, we're going to have this $8,000, and we have a paid-in capital from treasury stock of $1,000. But notice that our balance was only at $1,000. So we had $3,000 from when we had the difference, and then when we bought it back, we had to expend $3,000. Now we only have $1,000 left. So what happens in the case when we only have $1,000 left? Well, what we have to do is we have to pull from retained earnings. So remember, initially we had, I think it was $300,000 in retained earnings. So we had to use $2,000 of that in retained earnings to make up for that difference, because the paid-in capital from treasury stock was basically used up. So all of this was used up, and we didn't have anything left over. So we have to rely on retained earnings, and we have to pull from that, okay? And so therefore we have a treasury stock of $11,000, and as we said, we don't have enough paid-in capital in excess to offset the balance, so we have to pull from retained earnings. Okay.